Hello, my name is Carlos McWhorter, and today we are doing a fundamental analysis of Uber. We're going to dig into the financials of the business to see how much of a quality business is Uber, or is it not a quality business? And we have to understand one thing. A quality product does not mean a quality business. A company can have a great product, but if management doesn't handle their business well, then it doesn't mean it's a great business. Is it profitable? Are their margins strong? Is there cash flow? What are they doing with their capital allocation? And then we're going to break down what we think about this company, and I'm going to look at a fair valuation of it. So we're going to give a range on what I think the fair value of this business is. So let's get into it. So we have Uber Technologies. This company right now is selling at about 76.95 cents per share. Solid trend. Of course, many companies had this drop down in 2022. We have a solid increase. Get the pen going. We have a solid trend from that dip here in 2022. Again, a lot of companies experience that. So this is why you want to hold for the long term. Quality businesses do turn around. So right now, the stock is not very expensive. PE ratio of 16.88. Market cap right now, $162 billion. So pretty solid company, pretty sizable company right now, according to their market cap. So let's get into what is Uber. And one thing that we always have to understand, we got to understand where the revenues are coming from. We want to know what type of business it is. So the business segments let us know how they make their money. It's very important for us to know. So Uber's revenue split right now for 2024, 53% of their revenue comes from mobility. That is the ride sharing. That's what we know Uber to be, and how they pretty much created or disrupted the ride sharing industry through their mobility segment. 33% is the delivery. Now this is Uber Eats. So we also know that to be a big deal. I'm sure plenty of us have used their business there. What many people don't know, 14% of their revenues comes from freight. So they do have some technology that they use for freight carriers. So freight carriers can, like DHL and others, can use an Uber platform or a platform owned by Uber that they use to accept shipments. So a carrier can use their platform to accept a shipment and deliver to you. I know DHL and other smaller shipping companies or carrier companies utilize that platform. So 14% of their revenue comes from freight, from carriers and shippers. So just looking at the trends. So mobility may be 53% of their business, but is that the growing segment, or is it freight or delivery, the growing segment of their business taking over? So let's take a quick look down here at the growth rates. So we see freight, 226% growth in 22, negative 24% there. Mobility, again, the ride sharing, 102%, 41%. So on average, looks like freight is growing, even though they had a drop off. Freight is growing pretty fast, and mobility seems to be their consistent driver. So we'll see in the future how this plays out. That's one thing you have to understand about the company. As far as investing, you want to know what their future looks like. Is this going to be a future big time freight company? Or is this going to be delivery, or is ride sharing going to be the primary driver of their revenue growth? That's something that you have to understand and gain comfort over when you're going to invest. So looking at revenue and margin trends. Back in 2016, 3.8 billion, all the way up to 43.9 the past year. Pretty solid growth. 1 year of a negative growth here, 2020. Of course, that makes a lot of sense for them. So that's nothing that we're afraid of or alarming. It makes sense for that company since people were shut down and were quarantined. Gross profit trends, 1.6 all the way to 17 billion. So one thing I don't like, you see 42% up to 53, then back down to 39%. So that's not where we want to see a business that's growing. We don't want to see that gross margin trend down. So looks like their margins were trending up, and after 2020 starting to trend down. So You want to keep that in mind. Looks like costs are increasing and it's becoming more expensive for them to operate their business. So not growing efficient. So revenue solid, gross margins not so much because of this negative trend right here, 21 all the way up to 24. So let's look at profitability. I want to look at the net income of the business. I see that their margins are having some trouble, but I want to see how much money are they holding on to at the end of the year. So we see that Uber has not been a consistently profitable business. Negative 370 million in 2016. And over the past 10 years, we have 1, 2, 3 positive years. That's it. The last 2 years have been positive and pretty solid, strong trend, 120% growth, 422% growth. So we have a 5 and a 22% margin, profit margin. So that's pretty good. It looks like they might be turning the corner and they need to start stringing a few years together of consistent profitability and growing profitability. So we'll see how that turns out. But no, Uber has not been a consistently profitable company. They are what they consider to be in their early stages. Of course, it's not a very old company. I think the company is maybe 10 years old, if I'm not mistaken. So this does make sense for the stage of the business that they're in. They're still in their hyper growth state, not a mature business at all. So this is okay, I would say. Now going to free cash flow. Pretty similar to what we're seeing in the profit trends. Negative years and positive cash flow or positive free cash flow for the last 3 years. So when I say free cash flow, I'm talking about the cash that they generate from their operations minus their capital expenditures. The capital expenditures, that is their required reinvestment into the business to continue to grow. So their plant and equipment and software work that they're doing that they have to do to keep the doors open. This is what that represents. This is the cash that's left over. So negative cash flow in the early years, which makes sense for a startup. Now 3 years of positive cash flow that's growing at a very solid rate. So that is good. So what we're seeing with the profitability and the cash flow, solid, I say solid, I'll say a positive trend, but it's a new trend, 2 to 3 years. So it's not a really strong, solid trend. But it looks like they're moving in that direction. So let's look at the balance sheet. And I want to look at their debt to free cash flow. I want to look at how quickly a business can pay off their debt. Ideally, 3 to 5 years. That's what we want. However, we just look at where they are. So of course, they had this negative free cash flow that we just talked about. So of course, they're in a bad position these years as far as how fast they can pay off their debt. They're not producing cash to pay off their debt. So we see that their debt balance has started to increase, but so has their cash flow, where they're able to effectively pay off that debt in a few years if the company were to get into trouble. So we see 22, 28 years to pay off their debt. That's how much debt they had. Their free cash flow is 28 times. Now we get to 3 in 2023 and 1.6 in 2024. So again, pretty consistent in where we see negative years. The company is not able to generate cash. Now that they are generating cash, their balance sheet is in a much healthier position for the past 3 years, past 2 years, where if the company were to get into trouble, they are able to pay off their pay off their debt with free cash flow in less than 3 years. So again, positive trend, but not a very long positive trend. So the company does not pay a dividend. So let's look at the shares outstanding. Why do we look at shares outstanding? We don't like businesses that are bringing more people to the party, as I say. If they have a certain amount of outstanding shares, we want businesses to either hold on to that number or buy shares back and reduce the number of shareholders in the party. So when a company is selling shares, as we see Uber, this uptrend here, they're continuing to sell shares. They're bringing in cash and equity to the business by creating more shares and selling them. When those shareholders come in, the existing shareholders own less of the company. The pie does not get bigger when they sell shares. It's the same pie. Your slice just gets smaller and smaller. So we don't want share dilution. Now, again, we talked about Uber being in a not a mature company. They're in a growth state. So they're still in their kind of infancy state. I'll say they're probably a toddler when it comes to a business right now. So this does make sense for a company in that state because they need a lot of cash to continue to innovate and grow their business. So we think about this company in a short decade. They started off just being a ride sharing company and that grew. Then they started with the delivery with Uber Eats, that's growing. And now they're getting into freight. So they are still building this logistics platform that they're building, or logistics company. And they're still in the early stages. So how do you do that? You need a lot of cash to do that. And startups are not typically generating cash flow early on. So what do? They either go out and get more debt, as we see their debt has kind of gone up, or another thing they do, they sell shares to bring in debt-free, interest-free cash that they can put into their business. So this is something that we don't want to see when we're investing in a business, and this is consistent share dilution. But ideally, sooner or later, this company is going to start to, I would say, settle out as they become more mature, and this trend should reverse, if not stay pretty flat. So we don't like this, but it makes sense for the state that this business is in. Economic value added. So with this stat, what we're looking at, we want to know, or we want companies that take capital from two sources, debt or equity. Equity meaning selling shares and bringing in cash, or profit that's rolled over to the next year. We want our debt and equity. We want our management to invest this or deploy this cash in the proper way to create a return. So there's two differences when we're talking about profitability and return on capital. So I don't want you to get confused, so let me explain. So when I say profit or net income, I'm looking at, okay, you made $100, but you spent $70, you have $30 left over for this period, for this year. But you could have had $1,000 to use, $1,000 of capital to use to make money. So yeah, you might have had a profit because you only spent $70 and you made $100, so you have $30 profit for the year. That's great, but not so much because you had $1,000 to use to make money and you only made $30. Or you only profited $30. So that's the difference we want to look at. We don't only want a company to be profitable, meaning they brought in more money than they spent. We want a company to have healthy returns on their capital, meaning you're using the cash that you have at your disposal to create a higher return. So we want companies to deploy capital the right way. So what we do, we look at the returns on capital and we compare it to the weighted average cost of capital. What does that mean? That means the interest on the debt and the opportunity cost on the capital or the equity. Opportunity cost, I say 10%. You could take that money and invest in the S&P 500, 10%, and virtually no risk, make 10% on that money. So if you're going to invest that money into the business instead of investing in the market, your opportunity cost is 10%. Compare that to, we get the weighted average cost of capital for Uber right now, 7.2%. Compare that to the other software companies at 9.3%. It's pretty solid. They have a lower cost of capital than their competitors or people who are in the software application space. So when we look at the returns on capital, this is where we see we're not getting a great stat. -3%. That means Uber is not returning a profit based on the capital that they have at their disposal. So that's negative compared to the average at 19%. When we look at that, we have a spread of -21%. So over the past 5 years, Uber is averaging -11% in value creation. So instead of creating value, the business is technically losing economic value because the cash that they have at their disposal, they're not getting a return on it over the past 5 years. Now, this would look different if I were to look at the past 2 years or 3 years. As you remember, that's when they started turning a profit. So that would be positive if I were to look at that. But to keep things consistent, I look at the past 5 years when I'm looking at the economic value added. So right now, Uber is not in a good position over the past 5 years. Again, their trend now is trending positive for the past 2-3 years, but just not a very long trend. So this is not a good thing for them. But again, for the past 2 or 3 years, starting to look better. So this should look better year after year if they continue that trend. So let's look at the valuation. So Uber is estimated to grow at about 15% for the next few years. The discount rate, the weighted average cost of capital, 7.2. I put them at a terminal value. I think that if I were to invest in this business, I can expect a return of at least 12 times free cash flow. So with those stats there, I have the intrinsic value range of between $49 and $60. That's where I think Uber is valued at. If you were to catch it in that range, you're going to catch it within the fair value range. Now, with that said, right now they're at $76, so a little bit higher than that. If your dollar cost is averaging, so invest no matter what, depending on the price. So don't worry about the price and just continue to invest. And you don't have to worry about valuation. But if you have a lump sum of cash and you're looking to put it somewhere, if it were me, I might be a little bit wary of investing in something that I believe has about a 28% downside when it comes to their current price compared to their intrinsic value. So that is my estimate. So just to give you some background, as I like to do, or give you some variation, let's say you don't agree with me and my assumptions, and you say, I think Uber is going to grow at about 20%, and they're a much quality business than you think. You're just looking at their history as they're starting up, they're turning a profit, they're going to continue to turn a profit. And we say that we believe that we can get a return of at least 15 times free cash flow in the future. If you think that, then you're pretty much spot on. Price is 76, you think their value should be at 75, about $76. So you're pretty spot on as far as what you think the fair value range is. I have 68 to 83 based on those assumptions. But based on my assumptions, I have the business valued at $49 to $60. So that's just my estimate of what I think the value is, my assumptions. So looking at the summary of what we just covered, revenue, strong, I can't say strong trend. I keep saying strong trend, I'm misspeaking. A good trend, but not very strong, only a few years. Same with profitability, same with the free cash flow trend. Similar situation with the balance sheet. They're now turning a profit. They have consistent cash flow for the past 2 or 3 years. So right now they're in a very healthy balance sheet position as far as being able to pay off their debt very quickly. However, they just got into that position. So that's why I have a yellow there or orange check mark there. Shares outstanding. They are growing their shares. As you see, they have a solid uptrend of selling shares each and every year so far. Now, we do understand that the position that they're in could make sense as they're bringing in cash to put into further development of their platform. However, as investors, we always want to be wary of being diluted as a shareholder. So that's why we have an X there. Value creation over the past 5 years, they are not creating economic value. They're losing economic value because they're not earning a healthy return compared to the capital that they have at their disposal. So that's why we have an X there. In valuation, we have the company a little bit overvalued. I believe it was $49 to $60, which is what I think the fair value range is. Right now, they're at about $76, a little bit overvalued based on my assumptions. So that's my estimate or my fundamental analysis of Uber. Right now, the CEO, I heard him talking the other day on CNBC, he's looking at, or they're talking about autonomous vehicles and how that's going to change their industry. The only thing with self-driving cars is that we actually don't know what that's going to look like. So for instance, we don't know how much the company is going to have to invest into that technology to fully develop it. We don't know how long it's going to take for it to be deployed, for it to be widespread, and for consumers to truly adopt it. So we really don't know what that's going to take, what the margins are going to be with that. And yeah, you have drivers that you don't have to pay. However, what is the liability risk there? What is that going to cost? How much is insurance going to go up because you have these robots driving people versus people? How is that going to look? We don't know. So people have their assumptions, but that is their big opportunity as far as their mobility segment. And as an investor, that's something that you have to be comfortable with. They're putting a lot of money into it. We don't know how long that's going to take. We don't know how much money, how many billions of dollars they're going to have to put into it to get it to full operation and for it to be a part of their business model. And when that happens, we actually don't know what that business model is going to look like. So a lot of uncertainty there. I think there's some risk, but I think you got a strong business that's turning the corner on profitability. And as of right now, however long it takes for the autonomous vehicles to take over, right now they have a pretty successful business model where they can continue to turn profit and grow their profit with drivers right now. So if you're going to invest in this company, you got to be patient and understand that it's going to be a while before that takes over. So that's the big opportunity that you are hoping for. It might be a while for that. And again, we don't know how that's going to turn out. So that's my analysis of Uber. I hope you enjoyed this video, and I hope to see you in the next video.